Hey everyone, and welcome to this explainer. Today, we are diving deep into Warren Buffett's most brutal, cutthroat investment philosophies. And we aren't just going to do a history lesson here. We're actually going to translate his legendary concepts into a totally realistic, actionable playbook for young investors who are trying to navigate today's completely chaotic markets. So let's cut through all the financial noise and uncover the actual truth about building lasting wealth.
Okay, we've all heard the famous quote, right? Rule number one, never lose money. Rule number two, never forget rule number one. Now, let's just be real for a second. In a wildly volatile market, advice like that sounds almost annoying, doesn't it? Like, how on earth can you never lose a single penny when the markets are literally fluctuating every single second of the day? Well, today we're going to deconstruct this myth. We're going to reveal the hardcore reality of what Buffett actually means by capital preservation and exactly why this one rule is the absolute bedrock of his entire empire. All right, let's jump right into section one, the brutal math of loss and surviving historical market crashes. To truly get inside Buffett's mindset, we have to remember something crucial. He didn't build his incredible wealth during some magical, non-stop bull market where everything just went up and up. He lived through the Great Depression as a kid. He navigated the crushing stagflation of the 1970s. He survived the complete vaporization of wealth during the 2000 dot-com crash. And he weathered the absolute sheer panic of the 2008 Great Recession. So when he says never lose money, he isn't stressing over day-to-day stock price fluctuations or some temporary little dip in your portfolio. No, he is talking about surviving catastrophic events where your capital is completely destroyed. He's talking about avoiding the kind of losses that you simply cannot bounce back from. Because you guys, the mathematical reality of losing money is actually terrifying. Think about it. If you start with $100 and you lose 50% of your capital in a crash or just a really bad trade, you now have $50. But here is the brutal part. To get back to your original $100, you don't just need a 50% gain to recover. No, you need a massive 100% gain just to break even. You have to literally double your money just to get right back to the starting line. Buffett formulated his number one rule because he saw thousands of greedy investors get totally wiped out by treating the market like a casino, constantly digging themselves into these deep mathematical holes that they could just never climb out of. So, how do we avoid that? Let's look at section two core wealth pillars. These are his frameworks to protect capital. Because Buffett saw so many people absolutely destroyed by that brutal math, he relies on two critical frameworks to protect his capital at all costs. The first one is the economic moat. Think of a literal medieval castle with a giant, deep moat around it, protecting it from invaders. In the business world, an economic moat means looking for dominant companies that have a permanent competitive advantage and just incredible staying power. We're not talking about a company that has a trendy product for a year or two. We're talking about a brand or a system that is so deeply ingrained and powerful, think Coca-Cola or Apple, that competitors just cannot easily steal their customers. This moat protects your investment from being eroded by competition over the long haul.
The second pillar, which he actually learned directly from his mentor Benjamin Graham, is the margin of safety. This simply means buying an asset so far below its true intrinsic value that you have a built-in cushion if you're wrong, or if the economy just unexpectedly tanks. So if you do the math and figure out a stock is genuinely worth $100, you don't go and buy it at $95. You wait patiently for a market panic and you buy it at $70. That $30 gap, that is your margin of safety. It completely protects your capital from the unpredictable chaos of the real world.
Which leads us perfectly into this legendary piece of advice. Be fearful when others are greedy, and greedy when others are fearful. Buffett lived this exact philosophy during the absolute chaos of the 2008 financial crisis. While the rest of Wall Street was freaking out and selling off everything they owned, Buffett used that widespread, massive fear to create a huge margin of safety for himself. He literally stepped in and invested billions of dollars into massive institutions like Goldman Sachs and General Electric at rock-bottom prices. He basically let the panic of everyone else serve as his ultimate discount.
Let's move on to section 3, the young investor playbook. Here's how we're applying these billionaire rules today, looking ahead to 2026.
Okay, so we understand the billionaire's philosophy now, but the true beauty here is that we can execute these exact same principles today, right from our smartphones. Because look, while we don't have billions of dollars like Berkshire Hathaway sitting around to bail out major banks, we have something arguably way more valuable. We have time. But first, we really have to contrast two very different paths.
On one hand, you have the emotionally exhausting chaos of the modern hype train, chasing wild meme coins, getting financial advice from dancing TikTokers, and hunting for those magical hidden 100x penny stocks. But on the other hand, we have Buffett's disciplined, delightfully boring approach within his circle of competence. And this means focusing strictly on understanding real businesses, utilizing steady vehicles like S&P 500 index funds, and building a rock-solid emergency fund to protect yourself. So let's dive into a 4-step actionable playbook. These steps are designed specifically to help young investors navigate modern markets, build long-term wealth, and most importantly, keep your sanity entirely intact during wild market volatility. Let's break them down. Step 1. It's brutal, but it's absolutely necessary. You have to stop chasing the hype train. I mean it. The exact moment a social media influencer promises you that a coin or a stock is going to the moon, that is the exact moment you need to remember Buffett's quote and get extremely fearful. To protect your capital, you must commit to investing only in what you actually understand. Honestly, if you can't explain how a business makes its money to a 5-year-old, you probably shouldn't be putting your hard-earned cash into it. Step 2 is all about how we bring that margin of safety into the real world. For a young investor, a margin of safety isn't just about buying a stock at a discount. It actually starts right at home with your personal finances. You absolutely must establish a solid cash emergency fund before you even think about investing a dime. Why? Because think about it, if you invest your rent money or your grocery money and the market suddenly drops 10%, you are going to be forced to sell your investments at a loss just to survive. And doing that completely violates rule number 1. Your emergency fund is your personal margin of safety. Step 3 is to finally ditch the endless hunt for cheap, volatile penny stocks. Instead, you can use modern investment apps to accumulate fractional shares of absolute monsters. I am talking about companies with those incredibly strong economic moats we discussed earlier. You want companies that absolutely dominate their industries and possess the pricing power to raise their prices and resist inflation without losing a single customer. By buying fractional shares, you can literally own a piece of these massive, incredibly stable companies, regardless of how much capital you are starting with. And finally, step 4. You want to leverage a technique called dollar cost averaging, or DCA, specifically into low-cost S&P 500 index funds, which Buffett famously advocates for the average investor. By automatically setting your account up to invest a fixed amount of money every single month, completely ignoring whatever the news is saying that day, you take all the emotion out of investing. And the math here works out beautifully. This system automatically forces you to buy more shares when prices are cheap and fewer shares when prices are expensive. It is just a slow, steady, mechanical march toward wealth. Which brings us to our conclusion, Section 4, the boring truth. Wealth requires emotional discipline. All of these steps really build up to one fundamental, undeniable reality about long-term wealth. Buffett said it best, investing is not a game where the guy with a 160 IQ beats the guy with a 130 IQ. Emotional discipline is key. You see, the brutal truth of Warren Buffett's entire philosophy is that building wealth isn't actually supposed to be an adrenaline rush. To be completely honest, it's pretty boring. It requires immense patience and emotional discipline to just stay the course. You have to stick to your index funds and your fractional shares of strong companies while literally sitting there watching other people gamble on flashy get-rich-quick schemes. It is all about emotional control over raw intelligence. Having that discipline to not lose your money, to completely ignore the hype, and to just trust the math. That is exactly what separates the temporary winners from the permanent ones. Thank you so much for joining me for this explainer. I really hope this structured look at these concepts has brought some clarity to your own financial journey. Stay disciplined out there, stick to your rules, and before you go, I'd love for you to consider, what is your absolute favorite Warren Buffett rule?